If you work for 40 years and lose hundreds of thousands of dollars without realizing it, that is not a small mistake. That is a lifetime shift in wealth. Across America, this happens every day through long-term interest-based loans that quietly drain income year after year. This is not about fear. This is about simple math. When you borrow money with added charges attached, you agree to pay back more than you received. That extra amount may look small each month. Over decades, it becomes massive. Let's start with a real American example. Imagine a family in Georgia buys a $400,000 home using a 30-year loan at a common market rate. Their monthly payment feels manageable. They focus on qualifying. They celebrate moving in. Over 30 years, the total paid can reach close to $700,000 depending on the rate. That means around $300,000 or more leaves their pocket purely as borrowing cost. $300,000. That amount alone could buy another small property in many parts of the country. It could fully fund a child's education. It could build a serious investment portfolio. Instead, it slowly transfers away in scheduled payments. Now think about time. In the first 8 to 10 years of that loan, most of each monthly payment goes toward the added charges, not the main balance. Many Americans move before 10 years. When they move, they restart the process with a new loan. The heavy front-loaded cost starts again. The clock resets. The drain continues. Now let's look at vehicles. The average new car price in the United States has crossed $40,000. Many buyers finance it for 6 or 7 years. With added charges, that $40,000 vehicle may cost $48,000 or more over time. Then what happens? After 6 years, they upgrade again. Another financed car. Another 6-year cycle. Over 20 years, a household may easily pay $30,000 to $50,000 in borrowing cost just for transportation. That money does not build ownership. It disappears as financing expense. Now let's combine housing and vehicles. $300,000 in housing borrowing cost. $40,000 in vehicle borrowing cost. Education loans can add another $20,000 to $80,000 in extra costs depending on size and timeline. Suddenly, one middle-class household can lose $400,000 or more in lifetime borrowing cost. $400,000. That is not small. That is life-changing capital. Here's where it becomes even more serious. If that $400,000 had been invested gradually into broad U.S. stock market index funds, earning historical average returns near 8% annually over decades, it could grow to over $1 million. $1 million. The difference between paying interest and earning growth can easily cross 7 figures over a lifetime. This is why interest-based borrowing quietly reshapes financial futures. Most people never calculate lifetime totals. They calculate monthly comfort. Lenders present monthly numbers because monthly numbers feel manageable. The total lifetime number feels distant. But wealth is built over decades, not months. Let's look at income impact. An American professional earning $80,000 per year might take home around $60,000 after taxes depending on location. If $20,500 per month goes toward housing, $700 toward a vehicle, and other fixed borrowing payments exist, a large portion of income is locked before savings even begin. When income rises, many people upgrade homes or cars again using new loans. Payments increase. The cycle continues. Income grows. Obligations grow. Freedom does not grow. Heavy fixed payments also reduce flexibility. If job loss happens, payments do not pause easily. If someone wants to start a business, fixed obligations limit risk-taking. If relocation becomes necessary, contracts remain. Debt does not only reduce money, it reduces options. Public Federal Reserve data shows U.S. household debt reaching record highs in recent years. That means future income across millions of families is already committed. Now imagine 2 families in North Carolina earning identical salaries for 25 years. Family A limits long-term borrowing. They save aggressively before upgrading. They choose shorter repayment terms when necessary. They avoid constant refinancing. Family B finances almost every major purchase at long terms. They focus on lower monthly payments. After 25 years, Family A may hold strong investments and minimal obligations. Family B may own similar assets, but have transferred hundreds of thousands in added charges over time. Same income, very different wealth. Interest-based loans do not feel dangerous in the beginning. They feel helpful. They provide access. They speed up lifestyle upgrades. The true cost appears slowly. Month after month, year after year, decade after decade. By the time most people realize how much has been paid, The majority of their working life is already behind them. In the next part, we will break down how lifetime earnings shrink under repeated financing cycles, how refinancing resets cost again and again, and how small percentage differences create massive financial gaps over 40 years. Let us now zoom out and look at a full lifetime financial picture in very simple numbers. Imagine an American worker starts earning at age 25 and works until 65. 40 years of income. If their average annual income over that time is $85,000, their total lifetime earnings may cross $3 million before taxes. $3 million sounds powerful. Now let us subtract the long-term borrowing cost layer by layer. Housing first. Suppose they purchase 2 homes during their lifetime, each financed for 30 years. On average, each loan carries $250,000 to $350,000 in added costs depending on rates and size. Even conservatively, across 2 homes, the added borrowing costs may reach $500,000, $500,000. Now vehicles. If they finance a $40,000 vehicle every 7 years from age 25 to 60, that equals 5 vehicles. Now education loans. Many professionals carry $30,000 to $100,000 in student loans. Added charges over a decade or more can easily reach $20,000 to $60,000 beyond the original balance. Add conservative numbers together. $500,000 housing cost, $40,000 vehicle cost, $40,000 education cost. That equals $580,000. Over $500,000 transferred purely as borrowing cost. And this example is moderate. In higher-priced states, totals can be much larger. Now here's the real shock. If that $580,000 had been invested gradually into diversified U.S. equity markets earning long-term historical averages near 8%, over 40 years it could grow into well over $1.5 million, $1.5 million. This is the silent shift that most Americans never see. The system does not hide it. The numbers are in the contracts. The totals are printed. The emotional focus stays on approval and monthly comfort. Another hidden effect is refinancing behavior. When interest rates drop, homeowners refinance to lower monthly payments. Sometimes it reduces cost. Many times it extends the loan back to 30 years. This resets the early phase where added charges are higher. The borrower may feel relief each month, while extending total payments for many more years. Vehicle loans are also getting longer. 7-year loans reduce monthly pressure while increasing total cost. By the time the vehicle is fully paid, it may already be near the end of its most reliable years. Education borrowing delays wealth building during early career years. Those early years are powerful because investment growth has more time to compound. When income goes toward repayment instead of investment, compounding works slower. Let's compare 2 clear paths. Path 1. A professional in Colorado limits borrowing, makes large down payments, chooses shorter repayment terms, keeps vehicles longer, invests aggressively with extra cash. Path 2. Another professional with the same income upgrades frequently using long-term financing, refinances homes when possible, chooses lower monthly payments with longer timelines. After 30 years, Path 1 may hold a paid-off home earlier, strong investment accounts, and minimal obligations. Path 2 may still hold payments into later career years and smaller investment balances because a significant portion of income was committed to added charges. Same salary, different structure, different result. There is also stress impact. Households with heavy fixed payments experience higher financial anxiety, according to U.S. financial wellness surveys. Stress influences health and relationships. Financial pressure reduces negotiation power at work. When income must cover large fixed obligations, risk tolerance drops. Lower obligations increase freedom. Freedom allows smarter decisions. The key lesson is simple. Interest-based borrowing moves money from your future into your present with a cost attached. When used repeatedly over decades, that cost becomes enormous. The solution is not extreme behavior. The solution is awareness and planning. Calculate full lifetime totals before signing. Focus on total paid, not just monthly payment. Understand how early years of loans allocate money. Recognize how refinancing resets the cost clock. Choose shorter terms when possible. Save before upgrading. Every dollar not transferred as borrowing cost is a dollar that can build ownership and long-term strength. Wealth grows when money stays under your control and works for you. Wealth weakens when large portions of lifetime income are scheduled away in advance. America offers strong income opportunities. Protecting that income determines how much of it you actually keep. 40 years of work should build freedom, not constant payment cycles. Before committing your future income, calculate the full lifetime cost. Small percentages over long periods create massive outcomes. Your paycheck should strengthen your future, not quietly shrink it.